for more on those inflation numbers, we're now joined by Robert Embree. He's senior economist at Rosenberg Research. And of course, we're still joined by our featured guest of the morning, Patrick Horan. He's a principal at Agilith Capital. Robert, thanks a lot for coming in, first of all. So a big miss on the headline number. What do you think?
Well, this makes the Bank of Canada's job a little bit easier, but it doesn't necessarily mean that they're going to cut rates. They're still very concerned about all the uncertainty. The headline inflation number can be very volatile because of the changes in energy prices, the changes in the loonie. So I wouldn't be surprised if they still pause and wait another month. But certainly, I think this means that the 1.7 or so cuts that were priced in yesterday are going to be an underestimate. I wouldn't be surprised to see 3 over the next 9 months.
3 cuts of 25 basis points.
That sounds about right.
Right. Patrick?
So I guess as an economist, you have a particularly difficult job, probably more difficult than the past 20 years is my guess. And the Bank of Canada must be scratching their head. I keep hearing the willingness to move that target inflation from 2% to maybe 2.5%, 3%. What do you think the fudge factor is here of them actually talking their way around, what could be a difficult headline number and still being able to cut rates?
Well, certainly they would never frame it like that, Patrick. They're not going to say we're changing the target. No. But the question is, how long are they going to accept above target inflation? And I think the answer has to be because so much of this is driven by tariff-related pressures and uncertainty, probably as long as a year if they had to, right? Because 11 days ago, we got such a bad employment report. Canada lost 33,000 jobs. And we saw the wage numbers really moderating and continuing on that disinflationary trend we've seen over the last 3 months. I think that's going to be their focus, right? So they're going to look through the headline numbers a little bit, and they're going to focus, I think, on having a bias towards cutting rates to protect growth. But we won't see that as much till H2.
Is this inflation number this morning, the March number, is it emblematic? Is it a sign of a slowing economy, the big retreat in inflation?
Not necessarily. I mean, core inflation only slowed slightly.
Correct.
But this combined with what we saw in the employment number absolutely shows not a recession, but certainly a slowing economic trend, which makes total sense. It's not just that we've seen the tariffs, but we've had so much uncertainty that businesses are reducing their pace of capital expenditure, they're reducing their pace of hiring, and all that's going to keep flowing into the employment numbers and the CPI numbers.
One thing that StatsCan flags in the second paragraph of its release is lower prices for travel tours. Now, is it possible that's a reflection of the reluctance many Canadians have at booking trips into the United States?
Absolutely, and I think that trend's only going to continue. I mean, we're seeing in the U.S. numbers too, but that's just a small component of the overall basket, but certainly an interesting fact.
Yeah, so just on that theme with the basket, how frequently does StatsCan actually re-weight the basket? Because our consumer habits have changed almost on a dime here. We're seeing a lot of cheaper U.S. goods come in because of a weaker dollar. But I don't know if that's necessarily going to get reflected in actually our spending habits because we're avoiding the U.S. So how does that kind of all balance out with the basket?
Well, they don't update the basket that often, and it's done at the product level rather than the country level. So there's no component for U.S. food. There's just a component for food and some of the subcomponents there. So if the importing habits of Canadians shift, what they care about is the top line number. Now, I wouldn't be surprised to see some of that. That's not necessarily a concern in terms of the way that the basket works.
How much potential, your boss, David Rosenberg, has some pronounced views on public policy in Canada. How much potential is there for a shift in economic growth arising from a new government? That's going to be either a Liberal government with new leadership, obviously, or a Conservative government.
Well, both parties are proposing some types of tax cuts. And even though they've been talking about a lot in the election campaign, there's still a lot of uncertainty in terms of what would happen. I think the move by Carney to abandon the proposed capital gains tax increase is a good idea, but I wouldn't necessarily expect to see any large changes over the next couple of years. Whoever wins, their priority is going to be threading the needle on the tariff file, and that's by far the most important thing for the growth picture. You know, it would be very pro-growth in the long term if they did serious corporate tax reform, but I wouldn't hold my breath.
What about the pipeline issue and the drive to export more of our fossil fuels abroad?
Again, it's highly desirable, and I suspect whoever wins is going to think more about East-West rather than North-South exports. But this takes years to do.
Correct.
This is not something that you can reorient. So even if they go down that road aggressively in 2025, you wouldn't start to see investment numbers until 2026, and you're not going to start to see investment output till 2028.
Let me ask you a longer-term question. We could be entering an era like the 70s where the central banks kicked the can down the road, didn't address inflation because of wars and other geopolitical and changes and really a murky kind of inflationary outlook anyway. So do you think we're falling into that same trap here?
Probably not, but not through any benefit of the policymakers. The single biggest difference between now and the 70s is what's happening in the oil market, right? So the 70s, 1973, 1979, you have these huge exogenous oil price shocks, and that's what causes inflationary expectations to become unmoored. Today, we have the opposite. Oil is down over 15% from the peak. And last week, OPEC's announcement that they're going to actually increase supply for some countries really shows they don't have anything like the pricing power of the 1970s. And that's a very significant difference. So we would expect that downward pressure for headline inflation in Canada and the United States and around the world is going to continue. We don't see a lot of energy price inflation over the next 6 months. And
to follow on that, do you think headline inflation is a major benchmark setting expectation for core inflation? So habits follow kind of, but oil is kind of a leading indicator, or the price of oil effectively is a leading indicator for expectations.
It absolutely can be, but what we've seen is that as wage growth is moderated too, that's helping keep expectations from getting too out of whack. So we watch both numbers very closely.
Robert, thanks a great deal for your insight on numbers that you heard just seconds before you began talking about them. We really appreciate it.
Thanks, Paul.
Robert Embree. Embree is senior economist at Rosenberg Research. We are also helped along in that chat, of course, by Patrick Horan. He's our featured guest.